The market is currently pricing Lithium Americas Corp. NYSE LAC near the $3.38 handle, navigating a brutal stretch of sentiment compression that has left everyday retail investors utterly exhausted. If you pull up financial media headlines or scroll through modern investing subreddits and social feeds, the consensus narrative on lithium is drenched in short-sighted despair. Commentators look at the cyclical trough in spot lithium carbonate prices, point to near-term oversupply narratives originating from legacy producers, and declare that the energy transition narrative is dead in the water. But beneath this surface-level retail panic lies a profound, multi-layered market mispricing. Wall Street's standard models are treating Lithium Americas like a generic, cash-burning junior explorer vulnerable to commodity whims, completely missing the structural reality of geopolitical supply chain weaponization and chemical engineering moats. We are living through a massive structural shift where physical access to critical minerals inside friendly jurisdictions is no longer just a commercial asset, it is a matter of national security. While retail traders chase fleeting momentum plays or panic sell during routine macroeconomic jitters, institutional heavy-heads and sovereign balance sheets are playing an entirely different chess game. The hidden physical reality here is that building a domestic high-purity lithium supply chain in North America is constrained not by a lack of resource deposits, but by the excruciatingly complex chemical engineering bottlenecks required to extract battery-grade lithium carbonate from clay-based deposits like the McDermott caldera in northern Nevada. Standard financial media completely glosses over the metallurgical realities of processing acid-leached lithium from clay, viewing it through the same lens as simple hard rock spodumene or South American brine extraction. This fundamental misunderstanding creates a massive valuation disconnect between what the asset is actually worth as a geopolitical choke point and where the depressed equity price sits today. As we examine the day-to-day trading volumes and structural price action surrounding Lithium Americas, the dichotomy between institutional accumulation and retail capitulation becomes glaringly obvious. Daily turnover routinely experiences sharp spikes followed by periods of localized quiet, reflecting a textbook accumulation phase where smart money quietly absorbs shares being dumped by risk-disillusioned retail investors. Macro jitters driven by fluctuating interest rate expectations, alternating EV adoption growth curves, and shifting political winds in Washington act as a persistent pressure cooker. Retail traders, heavily influenced by algorithmic fear metrics and short-term volatility, get systematically shaken out of their positions during routine pullbacks. Every time the stock tests new local lows, stop losses are triggered, creating pools of liquidity that institutional players happily scoop up. These institutional heavyweights are not looking at next month's earnings report or the next marginal drop in spot commodity prices. They are positioning themselves for the structural deficit expected later this decade when gigafactories across North America are starved for domestic material. This brings us to a crucial checkpoint. Where do you stand in this market cycle? Are you currently holding a position in Lithium Americas and weathering the volatility, or are you sitting on the sidelines waiting for confirmation before stepping into the sector? Drop your thoughts, your average entry prices, or your portfolio strategies in the comments below, and let's dissect how you're playing the energy transition. To truly understand why Lithium Americas commands such strategic importance, we have to look past outdated historical framing that groups the company together with speculative exploration plays or cyclical commodity boom and bust cycles. The core operational focal point of the company is the Thacker Pass project in Humboldt County, Nevada, the largest known lithium resource in the United States. Historically, investors used to view mining companies as passive price takers, entirely at the mercy of global commodity swings, pumping capital into high-risk jurisdictions with unpredictable regulatory hurdles. Today, Lithium Americas operates as a critical infrastructure gatekeeper for the North American automotive and defense supply chains. The business model is shifting from a pure-play resource developer into an industrial-scale chemical processing engine. By focusing on onshoring production, the company is insulated from foreign export controls and geopolitical supply shocks that routinely disrupt global trade routes. The historical playbook of simply digging holes in the ground no longer applies. The modern imperative is the ability to refine battery-grade chemicals domestically at a commercial scale that satisfies the stringent purity demands of Tier 1 cell manufacturers. Looking toward the multi-year horizon, the catalysts lining up for Lithium Americas are tied directly to structural supply deficits and deep-pocketed strategic alliances. The company has successfully de-risked its capital expenditure requirements through transformational partnerships, most notably its multi-hundred-million-dollar joint venture and equity investments from General Motors, along with substantial structured financing from the U.S. Department of Energy. These are not ordinary corporate investments. They represent deep structural commitments from entities that literally cannot afford for domestic lithium production to fail. As construction advances towards initial production milestones, the narrative surrounding the stock will inevitably flip from a speculative development story to an operational cash flow reality. Of course, navigating this path requires acknowledging real-world risks, including execution hurdles in scaling novel clay processing metallurgy, potential construction delays, and the persistent capital expenditure burdens inherent in mega-scale mining projects. Furthermore, the broader pace of EV adoption among legacy automakers and the fluctuating capital allocation cycles of mega-cap tech and industrial spenders will continue to introduce short-term sentiment noise. However, the definitive takeaway for any serious investor looking past the daily ticker tape is that structural secular trends do not bend to short-term market pessimism. When you isolate the core physical reality that North America desperately needs secure domestic industrial-scale lithium to power the next generation of transportation and grid storage, the short-term price noise fades into irrelevance. Understanding this dynamic is the exact edge that separates long-term wealth creation from perpetual retail FOMO.